Good day and welcome to this is the first in our five-part series reflecting on the period to the 31st of December 2023. This one really is the big picture stuff, and that's exactly the title of the report. So the task with this really is just to look a little bit at some of the bigger issues driving economics, politics, really just creating the macro environment. And it's quite interesting when I speak to clients, and I don't know if it's a reflection of our age, but we're getting a lot of clients saying it sort of feels to them as though there's somewhat of a disconnect between the chaos, in inverted commas, that they see in the world and markets that seem to be fairly buoyant. So really, what we're going to do this time around, just look at things slightly differently rather than just unpacking all the regular slides. And really, for us, the million-dollar question right now is whether the world is actually more chaotic than asset markets are reflecting, as you can see there being the MSCI World Index, and also whether most people are not fully reflecting the chaotic environment. So rather than presenting only our own views, we thought it would be quite useful to get a perspective from the World Economic Forum, which, as you probably know, is a body that represents some great minds, corporates, government, and experts in a variety of fields, but particularly around sort of economics and the big picture stuff. And really what we thought we would just do is maybe pause and have a look at the key findings of the 20th Annual World Economic Forum's Global Risk Survey. And I'm going to go through these slides quite quickly because really all I'm trying to do is present a few of the other considerations rather than just looking at the vanilla elections and China-US tensions. The respondents, which was some 1,600 experts, when asked to rank the risk factors that they thought would have the greatest potential to have a material effect in 2024, extreme weather came out. 66% of the respondents put that down as a key variable. Interestingly, AI generated misinformation and disinformation second, then third, societal and or political polarization, the cost of living crisis, and we're getting a lot of that, particularly from those economies where income is not growing as rapidly as inflation has been. And then lastly, cyber attacks. So quite interestingly, in terms of the risks for 2024, two of those are actually technology. Then looking slightly differently, the survey respondents were also asked to rank on a 2-year view and then a 10-year view what they thought the most severe, in terms of impact, severe risks were. And as you can see on the shorter term, on the 2-year view, misinformation and disinformation interestingly came out tops, then extreme weather, societal polarization, cyber security, and then interstate armed conflict came in 5th place. So very similar to the very near-term view, but and there you can see lack of economic activity or opportunity, inflation, etc. on the 2-year view, and we'll go through those a little bit more later on. Interestingly, though, and this really is a theme that the WF and the survey has been highlighting for some time. And either you would say, well, like the broken clock, they would be right at a point in time, or it is indicative of maybe the slightly more strategic thinking that goes on there. As you can see, extreme weather, critical change to ecosystems of climate, biodiversity loss and ecosystem collapse, natural resource shortages, and then once again, misinformation and disinformation. And then the adverse outcomes of AI, interestingly, in 6th position. So very interesting that 4 of the top 5 long-term, the 10-year risks, are actually related to the environment, and a lot of that obviously to climate change. But interestingly, other than extreme weather, none of the others are really overlapping on the 2 and the 10-year. That's the 2-year risks, and as you can see, things like attacks on critical infrastructure, disrupted supply chain for food and energy, as well as censorship and erosion of free speech, all starting to feature. But right at the bottom there, you see housing bubble burst and tech bubble burst. So not much of a risk assigned to those, but that gives one a sense of where some of the experts are seeing the risks. This to me was probably the most powerful slide that I prepared coming out of the WEF findings, and this was, the participant outlook in terms of the degree of chaos that they were expecting on a 2-year and on a 10-year view. And it may be, that it's just the fear of the unknown that's causing a significantly higher level of anxiety about the 10-year view than the 2-year view. But as you can see, a total of 63% either expected a stormy or very turbulent environment in the next decade. Whereas short-term, people are a little bit more optimistic. Only 30% see that scenario. So clearly, there is growing anxiety that we're moving into a more turbulent world. And this, of course, covers everything from technology, society, politics, and economics, as well as climate and the environment. I found this very, very interesting as well. In terms of misinformation and disinformation becoming a big issue. And as you can see, it ranked in terms of the respondents in India, misinformation and disinformation actually emerged as the single biggest risk. Interestingly also, in the US, it was cited as the 6th biggest risk, 8th in the European Union, whereas, for us down south in Africa, it was only the 22nd biggest risk. But as you can see, it's definitely become a very, very important consideration in some of the key economies. Yeah. All right. So I mean, we're not saying this is gospel and we believe every word of it. Our thoughts is that it's not definitive. We feel, frankly, that not everything that comes out of the WEF Global Risk Report is always exactly on point. As best illustrated by the fact that the pandemic risks were completely unspotted in 1819. But I think a few of the things that stood out for me on a 2 to 10 year view, infectious diseases coming in at 23 and 19, I would have thought there would have been a higher level of sensitivity considering what we've been through. Debt, interestingly, also only 16 and 17 on a 2 and a 17 year view. I felt that the risk of food and general supply chain risks were very, very understated. And I think also the energy supply risks, courtesy of what we saw post the Ukrainian invasion, also we thought somewhat understated. And although the AI impact on employment is cited as a 10-year concern, we think it's likely to have a quite an important societal impact considerably before then. We thought that the policy impact of despots and uncontrolled or uncontrollable leaders, it's probably difficult to put it in a box, but I think that for us would be one of the biggest risks, where you get leadership that are either entrenched through political order, or because those that put them there and support them are unable to control them. So I think that policy impact of wayward or despot leadership is a very real risk in our mind. And I think populism in itself, and what we're continually referring to as the disappearing center, we would have thought was something that would definitely have deserved some attention. And then we agree 100% that the 10-year impact on climate and the environment is going to be massive. So generally we think there's a lot of wisdom in here, and it's worthwhile applying your mind to it. But as I say, it's not gospel, and we're not believing every single word of it. All right, then, just very quickly, a little bit on politics. It's a massive year. 2024 is a huge year. About 50% of the world's population is heading to the polls in 2024. If you exclude, countries where there is no vote, then it would be considerably higher than 50%. On that map, you can see obviously the US, significant parts of Europe, India, Pakistan, Russia, for what it's worth, as well as some of the Southeast Asian economies. So 64 nations, as you can see there, are expecting elections, as well as for the European Parliament, and a few countries in Europe have also got general elections and other massive elections. Okay, so you call politics at your peril, but our best guess on the probable outcomes of some of the bigger ones, it would be, I think it's quite clear that in the UK, Labour will take control. The US presidential election really is a flip of a coin. You're starting to find a lot of people sort of saying, well, neither candidate is really suitable. And you've got the likes of Nikki Haley, for example, attempting to, throw her hat in the ring. But yeah, it's a very difficult call at the moment. We sense that Biden is very unpopular, and Trump is either loved or hated. So it really is a difficult call at this stage. If it were to happen today, it would really be a neck and neck race, and may very well actually go, the White House may very well go back to Trump. The US Senate and House are also too close to call, and because they're so delicately balanced already, either the Senate could swing to the Republicans, or the House could swing the other way. It looks as though the BJP and Modi will be re-elected in India. We're not seeing massive shifts in the EU Parliament, and then general elections in Europe, kind of this extending of the theme that we spoke about in June, which is, a swing to the right, and interestingly, in some of those European economies, also simultaneously a swing to the left, and that really just means that center, that what we keep calling the pragmatic center, is disappearing. So I think the conclusion is that all bets are off in the US, but it will be a big deal, and obviously it'll come very late in our year. And quite interestingly, generally in the first year of a presidency, markets are normally fairly subdued. I think they're looking around 5 to 7% performance in their first year, which would obviously commence early in January. All right, I think the other thing that we thought was somewhat understated, especially considering what has been going on in the Middle East of late, is the risks of it's called an expanding or a cascading of, or contagion of interstate political risk or conflicts. And we've got just a few of the hotspots there. Obviously, China-Taiwan remains an issue, as does South Korea. China and India, Pakistan, always tensions there. Of course, the Ukrainian thing has the potential to really snowball very, very quickly, as does Gaza and the Middle East generally. And one that we think is being largely ignored is the role of Wagner in Africa. And we've got a growing sense that one of these or more may very well end up being that ticking time bomb that finally goes off. All right, very quickly on economics, a couple of the key themes. We did talk in a lot of detail about these in June. Some of the stuff hasn't changed massively, so we're going to try and focus on what we think is most relevant. If you look at inflation, it's falling, but it's still well above the targets, and we'll look at that in a second. And that's true regardless of where you're looking. So you've still got inflation around 4% in the US, in the UK, in the Euro area, and all of those have got targets of 2%. And what we're showing here is core inflation, which obviously eliminates some of the volatility around food and energy. But as you can see there, both in the UK and in the US, core rose a lot less steeply than the headline or the main print inflation number, but equally they are not falling as fast. So clearly there's some pressure there. Then commodity price pressure is easing, which we think is quite good from an inflation point of view. These charts are quite small, so you kind of have to take my word for it. But top left is the Brent crude oil price. You can see from the Ukrainian invasion, when prices spiked, they come back quite nicely. Brent around $80. OPEC Plus doing its level best to try and cut production to maintain those prices. But you do get the feeling that energy prices do want to drift a little bit lower. And yeah, then you've also got the wheat price at the bottom, which doesn't affect the core number that much, but it's been a massive driver of inflation, generally food inflation. And that's why we've also got, top right is the beef price. As you can see, that's also come back quite significantly. So all in all, we think that that augurs well for inflation, particularly in economies like South Africa, where food inflation really has been rampant. All right, again, the charts are small and hard to read, so you'll kind of have to take my word for it. But top left is the Fed dot plot. As you can see, fairly consistently expecting lower interest rates, so 24, 25, 26, and then probably stabilizing in the longer term at probably around the 2% mark on the Fed fund rate. You can see the rest of those are all bond yields, and you can see they've come back from their highs, with the US, for example, sitting at about 4% on the 10-year. So markets are clearly looking through the stubborn core and slightly sticky inflation, and we're assuming that rates are going to come off quite quickly. For the first time in 4 years, and that was very brief, real yields on US 10 years are finally positive, and that's on a combination of those yields having gone up, and of course on the bond yield, inflation having come down quite significantly. Right. Then, of course, the other important thing is the US yield curve. And as you can see here, hopefully, the yield curve very, very inverted up to about 10 years. Then there's a little bit of a hump, and then it goes lower again. So what is this telling us? I think the first thing is obviously tells us that the market is expecting fairly aggressive rate cuts from the Fed fairly soon. But it's also traditionally a very good predictor of a recession. Now, whether we get a technical recession or growth in the US slowing considerably is kind of not the point. It's really just that growth will be tough, and that the markets, I think, are a little bit vulnerable if they do prove to have been ahead of themselves in predicting rate cuts that are both steep and quick. All right, very quickly onto global growth. What we've done here is we've taken the G20 and we've spliced it into the Big 10 and then the other 10. As you can see, the US's last print was 1.9. 2024 expectation is 1.5, which is pretty low by recent past. And then you can see China at 4.6. Germany is really just positive. Japan also doing what it always does best. The UK, France, Italy, all percent or below, and even Canada coming in at 1.3. So I think then looking maybe at the next bracket being the smaller G20s, Argentina will see a contraction. Australia obviously quite dependent on what happens in commodity prices. But you can see the rest of the cluster also, a lot of 1%, 1.6, 1.7%. And only the likes of Indonesia, maybe below base, Saudi Arabia, really delivering anything to write home about. So I think the key message from that is that the world really needs India and China to grow. Obviously, the Chinese economy is a lot bigger, but as you can see, the Indian economy is now the 5th biggest in the world. So, arguably a 4.6% growth from China will actually give a stronger impetus to the world than maybe a 6.5 from India. But interestingly, we did the calculation. These are just simple averages. The G20 average growth rate for 2024 predicted at 2.1. If we take China and India out, it drops to 1.7, and that's kind of, I suppose, in a few economies approaching stall speed. So clearly the world needs China. All right, then, I mean, we're talking about Chinese GDP forecasts are coming at 4.6%. A lot of people might want to throw themselves off a bridge because, we've always been programmed or accustomed to expecting 6%. The reality is this economy has grown massively, and it becomes increasingly difficult for it to sustain those high growth rates. So, when you look at that trend, there is obviously some cause for anxiety, but I think it's important to just have context. And the first thing is that COVID, since 2020, the beginning of 2020, hit the Chinese economy very, very hard. Also, there's been an anti-graft and a cleaning up of corruption and maladministration, which we think has also been a deflator for GDP, as well as the exertion of political will by Xi Jinping and his central body. And all of that, in terms of new policy and prosperity for all, has had some impact on GDP. But we would say, if you think about, growth coming in at 4.5 to just over 5% of an economy of that size, it really is not a bad number. And even if you look at for example, post the global financial crisis, how well China was able to hold up and how it fueled the global economy in many ways. And it is our hope that they can, in 2024, deliver that sort of growth and offset, as we saw earlier, some pretty anemic growth rates from other economies. All right, then I think the important thing is, if we take PMI as a good indicator, leading indicator, if you look at some of those growth zones, India and China, the PMI numbers are looking pretty robust. India particularly, but even China at 52.6. And then also, interestingly, in the UK, also slightly expansionary in spite of the outlook for pretty benign GDP growth. But as you can see, PMI in South Africa and the others at the bottom of that table looking pretty bleak. But the important thing is what we are now calling the engine room for growth for 2024, looking pretty solid. Okay, then, some people would say, we must just get over ourselves and stop dollar bashing and stop bashing America. But, it is just such a massive economy. It sets the tone in everything from yield expectations, from money flows, so we cannot ignore it. What we've got, this chart really illustrates the budget deficit over some, just over 20 years. And as you can see, over the last few years, courtesy of COVID, those deficits swelled quite significantly, also post the GFC. But I think if you took a simple average of that period from the GFC to now, you're coming in probably around 5 or 6%. And even the best of those years was a 2.4% deficit. So it's kind of, that's what we've become accustomed to. And it might sound silly, but we describe this as the US having champagne taste and beer income. And the reason for that is that they're just clearly spending more money than they're earning. And I think for us, part of the problem and the thing that makes us concerned if we look further down the track is the fact that we don't get the sense that anybody is actually willing to do what is necessary to arrest this deficit, which just seems to have become embedded. As you can see there on the left-hand side, that's the aggregate US debt. So we're sort of up at about 35 trillion, and we just sort of limp from one debt ceiling and negotiation to the next. And then on the right-hand side, you can see the debt to GDP. Because the deficits remain and they remain stubborn, and we've got fairly low tax rates, and nobody's got the political will to hike them, and we continue to spend money, or the US will continue to spend money, it's really difficult to see a scenario in which those deficits turn into surpluses. And I think what we've got here is, on the left, we've got, the Democratic Party and Joe Biden with their social welfare, health, environmental bend, and they're not going to move on taxes. There's common spending. There's kind of just a base of spending that has to happen in terms of health and housing and education and veterans and increasingly, we believe, infrastructure. And then, of course, the Republican Party, particularly Donald Trump, wanting to spend more on defense and immigration control, and probably advocates for more tax relief, particularly because some of those roll off quite soon. So we feel it's unlikely to see a scenario in which the deficit is swung around and we actually start seeing debt to GDP eroding. So one of the things that we mentioned last time, and we're just sort of unpacking a little bit more on that, is US interest payments as a percentage of revenue. And you can see that's now up to almost 14%. You can see 2020, 2021, in spite of very, very high levels of aggregate debt, that bottom chart is showing you the average monthly interest rates on US debt. And of course, it's quite advantageous for the US to see those yields coming off, but there's been a very sharp increase in the average cost of debt, and we would imagine some of that is now reset, and we don't see those interest rates and cost of debt going back to where they were sort of post-COVID. So we believe to a degree that the emperor has no clothes, and one day it will become an issue, but it'll only frankly become an issue when it's an issue. But this economic picture, one of high levels of aggregate debt, rising costs of borrowing, and stubbornly high deficits, don't augur well for the US. And then finally, just very quickly, obviously climate and the environment was a big theme coming out of the WEF. We are very big believers in the energy transition. The chart on the left, quite difficult to read, but it's global electric vehicle sales, as you can see, up from 10 million units to 14 million units. So there's a 40% increase. I think we're now at a point where 1 in 3 cars in Europe is either plug-in electric or hybrid. And you can also see there, hopefully on the right-hand side, if you look at the German electricity grid, they're generating considerably more now from clean energy in the form of hydro, solar, wind, and less from fossil fuels, being oil, gas, diesel, and so on. So at least there's been some progress. We still believe the way for the world to radically reduce its CO2 emissions and start arresting the 2-degree, 3-degree scenario is for the electricity grid to be migrated. And we'll talk a little bit more in the subsequent videos about investments like Brookfield Renewable. So our conclusion is that the global picture is actually quite a lot more chaotic and uncertain, with declining visibility than we would like, and that maybe markets are a little optimistic in terms of their outlook on rate cuts. Having said that, we do believe that we've got some people on our side. We've got some of the central bankers up there, from the Fed to the Bank of England and the ECB, as well as the finance ministers, and we just put Xi Jinping in there as well, because I think a lot of what comes out of China is his own policy thoughts. So we really do have that embedded put. The problem is we're not entirely sure, if we look 10 years forward, whether they will be able to fulfill those undertakings, but at least on the short term, that gives us some comfort. All right, then looking to the local picture, of course, the challenges remain. 2 charts we've got up here being business confidence, which, apart from the 2020 crisis, and really business confidence hasn't been this low in a very, very long time. And then, of course, youth unemployment, it's eased back, it's under 60%. But that, as we've spoken of before, is a social time bomb. And the challenges and the reasons that we're sitting with these low confidence levels, anemic growth, is just around the things we all know about: Eskom and Transnet, corruption, and the dysfunction of other SOEs like Transnet. Of course, the big thing for South Africa in 2024 is the elections. On the left are the existing parties in the General Assembly, but there's a whole string of new parties, and the question is how many pages long is the new ballot form going to be? A couple of the new kids on the block from a general election point of view, of course, you've got Action SA, ACT, Rise Mzansi, Mkhonto Sizwe, Zeluva, just to mention a few. I think the big question on everybody's mind is whether a united opposition is a credible alternative to the ANC government, and I think the answer to that is time will tell. What we thought of doing is, because it is useful to at least contextualize and conceptualize these things. What we see is, I mean, there are many potential outcomes, but we see 4 scenarios. The first is one in which the ANC, I'm talking about the election results, it gets its 50% majority. It's looking increasingly unlikely, particularly if a general election was held earlier rather than later, which leads to the possibility of scenario 2, which is where the ANC comes in under 50%, maybe 45, 47, 43, and you have a kingmaker or 2 who then get them to that magical 50% level. Our best sense is that an ANC-EFF coalition could be disastrous, not only because of the policy divide and the antagonism, but also because of the evidence we've seen with the EFF in terms of their participation in coalitions. A third scenario, which is probably about a 35–40% possibility, depending on how the glue that binds this unified opposition holds, is a third scenario in which the unified opposition coalition manages to squeeze out 50%. It'll probably initially be well received by markets, but that could soon turn to a little bit of despair, because let's be honest, South African politicians, when it comes to coalitions, are inexperienced, and we frankly just don't know how to operate coalition politics in large part. And then a fourth scenario is one where the ANC gets under 50 but forms workable and sensible coalitions with a few smaller parties, and we don't want to hypothesize who they may be. It's probably one of the less likely scenarios, but it could actually be quite good depending on who forms that coalition. Obviously, the first scenario, one where the ANC gets its 50%, for a lot of people would be frustrating, but I think a lot of other people would see that as a business as usual. But it will require the ANC, I think, to do things a little bit differently over the next 5 years, as has happened over the last. And I think starting with, rebuilding the trust, with their trust deficit between government and the private sector, and civil society and labour has been eroded. I think that would be a top priority. So, it's difficult to call. Our best guess is an ANC outright majority is probably around a 40% probability. Scenario 2 is probably around a 20% probability. 4, we think a fairly low probability, with scenario 3 probably coming in around 30%, depending, of course, on what the conditions are and what the voter turnout looks like in May, or whenever we finally get to the polls. They say sometimes a currency is a reflection of you, and it's almost like the share price of the country, in which case all we can say is, the rand at almost the weakest levels against all the major crosses, maybe slightly less so against the euro, but it's 6 of one, half a dozen of the other. It really is, I think, reflecting a lot of anxiety about the future, about policy, about our ability to arrest the dysfunction of Transnet and a few of the other SOEs that have become so critical to driving GDP. Okay, so that's all the bad news and the confusion. The good news, we would say, is inflation's back in range. On the left-hand side is the headline inflation print, and on the right-hand side is the core number. Just as we saw in the UK and the US and Europe, core is a lot slower to move, but it's also sitting just bang on that midpoint. Whereas we're still back below the 6%. Inflation did spike a few months ago. It does seem to be on its way down, and we're fairly confident that the SARB may be a little bit too negative or too conservative in forecasting the easing in inflation. But that all leads us to what markets are expecting from an interest rate point of view. We've got the FRA curve, the forward rate agreement curve here. And as you can see from the 1x4 sitting at about 8.3, we're looking at rates coming off. I think it's on the 21x24, if I remember correctly, at the end there around 7.4. So the market looking for around 100 basis points over the next 2 years. We don't see anything happening, even if it should, until the election's over. So we would guess best case scenario rates will start being cut in July. But we wouldn't be surprised to see the 50 bp, two more recent hikes or last hikes being unraveled, simply because once the evidence is there of slowing inflation, we feel that the SARB will have to ease monetary policy. Of course, the wild card here is with Kuben Naidu having left. The composition has changed a little bit, but we do hope that the SARB will follow the data, and we are hopeful that the data will facilitate lower rates. Because you do see quite a lot of strain, particularly in middle-income households. Then very quickly, our yield curve is not inverted, it's not flat. It's actually quite sharply positive if you go from sort of the 5-6 year mark. Short-term rates obviously not far from where call is or where the official rate is, and then increasing very, very quickly. And we're seeing very good value, in the sort of maybe just beyond the 10-year mark, where you're getting yields of around 11% up to 12%. So quite a lot of value in the South African yield curve is looking attractive. And just again for context, if you're in a living annuity or something similar, where you are targeting, a withdrawal rate of 8 or 9. For the first time in a while, bonds are actually able to make a positive contribution. Then very quickly, growth in South Africa. You can see Trading Economics is forecasting an acceleration in growth. We're probably in a technical recession, but whether you've got 0.5% positive or 0.2 negative, it's really semantics. But we would look forward to an improving environment, particularly if we can arrest the Transnet situation. And if I can just say one thing on that, caught Minister Godongwana recently on Bloomberg, and something he said really resonated with me, where he said we must not make the mistake of trying to fix the entity like a Transnet or an Eskom and resolve the problem, i.e. power generation or distribution or the transport infrastructure, that fixing the organization and fixing the problem are often two separate things, and you're getting the strong sense that government is very, very keen on public-private partnerships, particularly in Transnet, so that it doesn't require, telephone numbers of funding from government. So, yeah, there are a couple of things that are starting to look a little bit better. Then finally, last time around when we spoke South Africa, we had that beautiful picture of the lion. So we thought, a lion who's obviously been in a few fights in his time is probably a good idiom or metaphor for South African investors and the South African public. Our conclusion, obviously, South Africa, the outlook is tough. We can see it in asset markets. But we would say, as we said last time around, that there's a lot of bad news baked in. There's a lot of uncertainty. The markets really don't like uncertainty. Bad news you can deal with, but we do feel that there's a lot of negativity baked in. We believe that the South African economy, South African business, South African consumers even are incredibly resilient and resourceful. You know, if you had the collapse of an electricity grid and the Transnet issues elsewhere in the world, you know, those economies would have completely imploded. Here we are limping along with virtually flat GDP. That in itself is a testament to the people. We will, in the next video, which is asset market performances, we'll look a little bit more at South African assets in absolute terms, but also relative to their peer group. Just safe to say right now that SA assets are looking attractive. We briefly touched on bonds. And then I think the last thing is that, as we said last time around, it's very easy when there's so much uncertainty and anxiety to be negative, and you can very easily be caught flat-footed. So our conclusion is that South Africa is like this lion. It's still standing, it's still fighting, but it's really been a tough few years, and we've got the scars to prove it. But we do think that South Africa could actually prove a lot of the naysayers and the doomsday sayers wrong, particularly from an asset price point of view. This, as we said, is the first in a 5-part series. The next one will be the asset market review. We'll then delve a little bit into the local portfolio holdings and how those have performed, with some deeper dive into 1 or 2 of the holdings. We'll do a similar thing with the offshore holdings, and then the last of the 5-part series will be a deeper unpack of the Kerner BCI flexible fund, how it's performed, how it's positioned, and how we see that going forward. We hope that this has been of value to you, and we look forward to your feedback. Thank you.